Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young, and today is April 24th, 2025. We're going to be talking today about industrials, financials, and the movement of commodities. To begin with, we're going to show some of the news today. The economic news that we knew that were calendared would be the core durable goods, weekly unemployment claims, and existing home sales. You might notice here that durable goods orders, these are your bigger ticket items, your dishwashers, your refrigerators. And what they're telling us is that we had a major increase in durable goods orders. So people are buying big ticket items. You can see that's a major spike through here. And that is usually a good sign for the economy, but you can see it can be very sporadic. Highs, lows, lower lows, higher highs, lower lows, higher highs, lower lows. And so we keep creating this expansion through here, well, where we're seeing a major increase and then a major drop into negative territory, up and down. And that expansion tells us it's pretty difficult to use this as a quantitative measure on the overall health of the consumer on their durable goods orders. So I'm cautiously optimistic with what I'm seeing in this chart that we are buying bigger ticket items. Maybe we're less pausing on those, yet it's probably not enough for a 1 month data point to tell us that's good to go. In fact, as we're looking at this, if you look at the revisions, you can see most of those revisions are lower. And so we might have reported a really big number and we might report a significantly lower revision next month. I don't know. We'll have to wait and see. So I'm not putting a lot of credit or a lot of stock, no pun intended, into durable goods orders. But I am looking at this existing home sales. We know that rate, even here, Fed Hammock says time for Fed to be patient on policy. We know that Jerome Powell said we're not cutting rates because we have inflation. And so we're sitting here in a holding pattern with rates, and that is having some impact, negative impact of that, on existing home sales. Yesterday, we reported new home sales going higher, but I want you to look at the difference in numbers. Yes, we may have sold more existing homes than what we had planned, but a couple things we want to note. We went from previous 4.27 million down to 4.02. Forget the forecast. We can guess on what they think is going to happen, but I'm much more interested to see the pattern. And we went from 4.27 down to 4.02, which means there was less existing home sales by 250,000 homes. If we look at new homes yesterday, there we go, it increased from the previous by about 50. So 50,000 up, 250,000 down in existing homes. So net from the previous month, all home sales, new and existing home sales, fell by 200,000 homes. So I don't think this is a great sign for new home construction. I think they've discounted. We're seeing that happen across the board. They're discounting the home prices to get their inventories sold, but existing homes are going and declining in sales. So the economic data would say, based off last month, new home sales are doing better. You can see we bounced off the lows, but to me, we're still in a significant downtrend. So in all of this, we have good news, we have bad news. We have rates staying higher, which theoretically is bad news for the economy, at least growth, and higher costs means bad news for home builders. And yet we have tariffs being delayed, except they're being applied, except deals are going to be done, except they're not going to be done. And so a lot of confusion with the tariff situation. And all in all, I think this is now the time to say, okay, the news, the data, the reports are going to be very difficult to trade off of. So instead, what we need to be focusing on is focusing on what the charts are doing, what price action is doing in the midst of all of this. So if we can pay attention to that, we're going to see that industrials and technology were the top two. I'm going to avoid technology because I think it was overly accelerated in today's move off of hope. But we're going to look at industrials being one of the top performers. And as we look at XLI, if it was really this growth factor that we'd expect to see in early recovery, financials should have done a lot better and done a lot better earlier. Industrials have rallied and climbed up to this level, and we can see that we've erased all of this, one of the best recoveries we've had, closing back through the support, but we don't have the financials to back it. So I am cautiously optimistic for industrials, but I want to see some breakouts and accelerations in industrials to set up the next trade opportunities. If we look at financials, as these two are oftentimes cycling one behind the other, financials has a similar price pattern, but today had barely a move compared to industrials. Industrials gained twice as much than financials did, and financials, the way I see this, is hitting its head on resistance. Let me change my indicator here at the bottom to a stochastic, and if we're looking at this from a stochastic perspective, we still have the potential to create a bearish divergence up here, which would have me looking for a retest of the bottom of the channel. I don't know yet, so I'm going to look to fade some of the weaker financials, and looking at the industrials, going back to XLI, having gained 2.4%, I'm looking at this as possibly the breakout, because we're a long way from creating a bearish divergence still, and we've cleared the previous high today, and we've set up to close above in the next 4 minutes, close above the gap, which means that the gap filling should go up to 133. Looking at individual stocks inside of here, I am fascinated with Boeing's resilience to the fact that China has canceled orders and even return planes, and you can see that Boeing is closing above its Bollinger Band. That's a buy signal for my methodology. We broke what little divergences were there that didn't confirm and gapped up, closed higher. Now, that is on earnings. We responded to that. We're netting out positive. So despite everything that happened, despite what we saw, one of the best earnings, still negative, but one of the best earnings that Boeing has had in years, and we're seeing this push through this level. So it's interesting to me. I may be interested in buying a long call vertical with a defined risk target, maybe up to 190, 195, but I'd also be interested in running the numbers on a short put vertical to see if we can collect enough premium on Boeing with the extra volatility that's going on in that market. We look at something like Caterpillar. Caterpillar has made higher highs, higher lows after the big gap down. We do have earnings, but as you can see right through there, we have filled the gap and closed past the gap. So super discounted on Caterpillar, and it looks to me like we've completed a reversal with making higher highs, higher lows, and filled the gap. So I do like these stocks. I like the setups that we're seeing inside of here. We could also look at things like Raytheon and RTX. Here is a bounce off the lows after earnings. I would like to see it fill the gap, but I don't mind the idea of buying through here early. And one other that kind of looks interesting to me, if it creates this higher high, higher low by getting through 201, would be Honeywell. If Honeywell can clear 201, I'm looking for 217, 218 through here, and then potentially filling this gap from the previous earnings all the way back to 222. It has overshot, created higher highs, higher lows, if it can get through 201, 202. And so there's an opportunity to potentially make 5 to 10% on Honeywell. Now, if we look at the opposite side of that and say that we didn't get the rally like we would have expected in financials, let's take a look at the bearish side on financials. Starting out with the biggest consumer financial, which is Visa. Visa appears to be playing this channel very, very well. It broke out, hit the top of the channel, broke down, hit the bottom of the channel. We've returned to the top of the channel and are defending the top of this channel. I see this as a low risk, high reward opportunity to fade this or short this until or unless we break through 343. So we could easily drop back down to 300, which is going to be a 12% drop. And we do have earnings. If we see lower transactions, if we see the consumers and businesses using their Visa less, that's all we're talking about. Doesn't mean that they have to not be buying, but they're buying less. Visa is driven by transactions. And so if we see the transactions playing out to lower and lower levels, then we should expect to see Visa struggle. That's what I'm looking for here. Now, something worse than Visa would be something like Ally, which is leveraged into consumer finance, and oftentimes the subprime credit. We can see we've got lower highs, lower lows, lower highs, lower lows. It's failed to break free. We're already past earnings. Generally, there's a dip around dividends. And so I might be looking at this as an opportunity to fade or go short and play this down to the support level. There's not a lot of dollar movement here, but it's about a 10% drop to fade the 33 back down to the 29. And I do like Ally for a short position or a short call vertical on Ally. And the last one is a quote-unquote bank that relies heavily on consumer discretionary spending, but we don't always look at it as a bank, but it is primarily a bank. It does actually make a lot of money by holding on to customers' money, and that is Starbucks. Yeah, Starbucks is a bank at some level because it holds tons of money in their app, and it is a zero interest payment. So they collect and hold that, and they can make money on those consumers. If they have less money in the apps and are not buying as much Starbucks, this would be an opportunity to fade and go short here as well. Earnings is coming up. I expect to probably see a miss on earnings, whether we've priced it in already. I expect to see a miss on earnings, that the new craze is at-home cafe, and all that's going to do is say less demand for Starbucks. What do we see? We do have earnings. Be careful. However, if we see it fail here at 87.88 and go back to the lows, and even better, if we break out of this bearish descending triangle, I would expect that we could drop about $12 to $15 from the current price, which means that we could see a 15 to 20% decline in Starbucks at or around earnings. And it is a little more sketchy. You got to be a little more careful with it because of earnings, but I do like the downside for Starbucks as both a consumer discretionary stock and a bank stock. And just as a reminder, we're pretty much past all the financial stocks, the big banks that are going into earnings. They already had their earnings, so a lot of the recovery here back to the previous channel is based off of the data that we've already got. We don't have a lot of big banks coming out and reporting new earnings, and so I would be looking to fade this with short call vertical if you can get paid enough on financials if you want to diversify away from individual stocks. And that move there, again, failing at 48, back down to 46 is 5%. But if we break through that support, then we would be duplicating that 5% move, and I'd be looking for a 10% move back down to about 43 or 44 on financials. Well, that's going to do it for me today. Join me again tomorrow in the main room at TheoTRADE as we look at some long-term trades and trend setups, as well as some sector rotations. And join me again next week as we do our afternoon video. And certainly join me on the earnings flips call for those of you that are in the earnings flips class, and we'll be doing that on Tuesday. Have a fantastic night and a great weekend.